What's up everyone, it's Scotty with Money Investing. So Nasdaq here pushing higher with the S&P 500 and the Dow Jones pulling back. So we know clearly which stocks outperformed on the day after the inflation numbers came out. So hope you guys are doing great. If you enjoyed this video and find it helpful, make sure that you drop a like. We got lots to unpack in this video. We're going to talk a little bit about inflation. We're going to talk about market concentration, a new text channel that I've created for all the members, and of course the market technicals and where we are with respect to the resistance and the bear camp. So make sure that you drop a like, subscribe. Link to our Discord and Patreon is going to be down below if you're interested in joining us. And there is a 16% annual discount available if you want to take advantage of that and of course get access to all the alerts, including all the buy and sell alerts, investing alerts. We are resuming, or at least I'm resuming, my experiment and my dollar cost averaging strategy on the VUG ETF, the Vanguard Growth ETF. And I also did sell covered calls on AMD, which are now up a little bit over 29% in just one day, so almost 30%. And as soon as they're up over 75 to 80%, which could happen tomorrow if AMD starts to pull back here again, I will be closing them out. And I did sell covered calls on Meta, sold some cash secured puts on PayPal yesterday, and then we'll be selling some more cash secured puts probably on a Twilio as well, which I ended up adding as a new position today. So all of those alerts are going to be available with the link down below. This right here is the new text channel that you can follow. Again, you can literally turn on notifications on your phone so you get all the updates directly to your phone if you don't have the time to obviously catch up to all the videos that I've been posting, or if you don't want to spend too much time, you can quickly just browse through and read and get up to speed with where we are with different things or different parts of the economy and the market. So for example, and this is just an example, I'm not going to be sharing everything I share in the text channel moving forward, but this is just to give you an idea on what you can expect. So just as an example, I texted today in the morning, good CPI print, 1 out of 4 optimistic case, and the other 3 coming in line with expectations, in other words, the base case. And the key takeaways are as follows. Shelter prices still up, but at a much slower pace, only 0.4% compared to 0.7, 0.8% as we have seen in the past. Year over year also coming down to 8.1%. Energy was slightly up month over month, but fuel, oil, and utility gas was down month over month. Food prices also showing signs of deflation for the first time as food at home saw a decline of 0.2%, and both energy and food declines helped headline CPI to be lower and come in under 5% as headline is now sitting at 4.9%. Couple other takeaways. Shelter is still tricky. We need to see shelter prices decline month over month. Consider this. Right now, 0.4% month over month annualized is 4.8% year over year. So all things constant, core inflation would be at least 4.8% unless shelter starts declining. In other words, negative month over month. And Fed funds rate is now above the headline CPI for the first time in 2 years. In other words, the Fed funds at over 5% is greater than CPI at 4.9%, and that is good as it puts more pressure on overall inflation. Wages are still up as we see the employment report and up over 4% year over year, and that needs to come down eventually so that it puts more pressure on inflation to the downside. And overall, this was a good report suggesting potential downside for aggregate prices and continues to emphasize the importance for both shelter and for wages. So this right here were the numbers. So as we already know, the actual number came in at 0.4% month over month increase in CPI. Year over year, we came in at 4.9%, which was better and optimistic for the markets, and 0.5% month over month for core and 5.5% for year over year. So we came in line with base expectations for 3 out of the 4 metrics, and 1, which was year over year inflation, came in below the expectations. And one more thing that I want to point out is that deflation is different from disinflation, right? So deflation is prices decreasing, prices actually declining negative month over month. So if in other words, prices were down negative 2% or 3% or 5%, that's deflation. But disinflation means prices are still increasing, but at a slower pace. And that's what happened with shelter. So I go on by saying that shelter prices just experienced disinflation. Energy and food experienced deflation. So there's a difference that we have to understand when it comes to these two terms. So that's a little bit of an idea and give you an example of what we will talk about, what I'll share in the text channel. And this right here is another a little bit of a different update on the text channel, which I pretty much mentioned that I ended up rereading The Little Book That Beats the Market by Joel Greenblatt for the 5th time and couldn't help but share this small excerpt which talks about the psyche of the big money managers and their time horizon. think about this: the next time a high quality company sells off and the stock continues to sell off. And note, this is often referred to as, quote, style drift, and you can look that up if you want to in the investment world. Style drift happens when we start chasing returns by ditching our existing strategy. So what this excerpt really talks about is the idea, or if I go over to the next page, so the investment time horizon is too short. And this, we're talking about big money, hedge fund managers, professional money managers. And if a strategy works in the long run, meaning it sometimes takes 3, 4, or even 5 years to show its stuff, most people won't stick with it. After a year or two of performing worse than the market averages or earning lower returns than their friends or their peers, most people look for a new strategy, usually one that has done well over the past few years. Even professional money managers who believe their strategy will work over the long term have had a hard time sticking with it. After a few years of poor performance relative to the market or to their competitors, the vast majority of clients and investors just leave. And that's why it's hard to stick with a strategy that doesn't follow along with everyone else's. And many managers feel that the only way to avoid that risk is to invest pretty much the way everyone else does. And often this means that owning most popular companies, usually the ones that the prospect looks promising for the next few quarters or the next year or two. So this gives you a little bit of an understanding. You remember in the channel, I've always mentioned before that there is always a discrepancy between institutional and retail investors in their time horizon. And I've always mentioned that retail is positioned long, institutional is positioned short term. In other words, the time horizon. We're not talking about the actual action itself. I'm not saying the institutional investors are shorting the market while retail is going long. No, I'm talking about the time horizon. There's a discrepancy because retail's most often or not is positioned for the long term, whereas institutional investors and professional money managers, hedge fund managers, they're mostly positioned for the short term because they're looking to beat their benchmark. They're looking to beat their index. So when we do see a quality company sell off, like for example PayPal or even any other company for that matter, oftentimes that happens on the back of just not the prospects of the next couple of quarters not being great. They're not looking at the long term. They're not looking at what these companies or what their strategy can do over the next 2, 3, 4, 5 years, but they're just looking at the quarter itself. And that's why last year we had a rotation into energy. This year we're having a rotation into technology. And I can give you some prime examples like Cathie Wood and Ark Invest. When they were going up, they were getting a lot of inflows, billions of dollars of inflows, because that's the strategy that was working at the time. And now when we have completely shifted, the markets have shifted, interest rates have gone up, and their strategy is down over 80, 90%. Everybody wants to disregard Cathie Wood. And, a small part of me still thinks that, hey, look, if they are sticking to their strategy, they're not going through that style drift where they start chasing return and start actively allocating money into sectors that are moving higher, it's possible that they might end up on top once again, once the odds are back in their favor. They just need to be able to survive this time period where their strategy is not performing well. Something to think about. There's a lot of conversations and discussions around survival in the markets, around survival for companies in the world where competition's so high, and of course discussions around style drift, market returns, just beating the market and all those things, and becomes very, very interesting topics of discussion. So again, links gonna be down below if you want to discuss more and if you want to be a part of our community, and of course get access to all the alerts and the text channel as well. Anyway, NASDAQ closes 1% higher on Wednesday as inflation data cools off. So NASDAQ was up over 1%. We did have the S&P 500 and the Dow Jones pulling back, or the S&P 500 added close to 45 basis points. So this right here is the S&P up over 45 basis points, so pushing higher on the back of tech, of course. And we did have also the NASDAQ moving higher, up over 1%, and the Dow Jones here slightly lower as the Dow is not as aggressively weighed in tech as, of course, NASDAQ or S&P 500 are. So seeing a little bit of a pullback on the Dow. So April consumer prices we've already gone over. So Ed Moya, senior market analyst at Oanda, said optimism for disinflation process to remain in place is high, as this report showed shelter prices remain elevated, which just means the lag we are seeing with rent prices should start to meaningfully show over the few months. And inflation should continue to decline over the next few months, but falling back to 2% will be a lot harder given the strength in the labor market because of the wages that I mentioned in my text channel earlier. So with each passing month without slowing in core inflation, the chances of getting down to the FOMC's forecast for the year are receding. And so to me, this is not a dovish result. So what they're really talking about is the fact that shelter prices are taking time to come down. Shelter prices are not really slowing down as quickly as what many people anticipated, and they're going off with a very, very significant lag. So it's really going to be on shelter. If shelter prices don't come down, core inflation is going to stay pretty elevated, and that's gonna put additional pressure on the Fed to continue to maybe raise rates or do something about the shelter prices, rents specifically, in order to bring them down. So Tom Lee mentions that FANG stocks could soar up to 50% this year, and he mentions, and I quote, "As this year unfolded, it really looks like FANG, and I'm being a little broader here, including things like Nvidia and semis, are so relevant to how you deal with inflation, whether it's through AI or automation. So these incredibly important companies." And he added that you can't really say that you're going to have a diminished demand for these products. It's actually going to grow, and there's not new competition. So actually, their ability to make profits is higher, and that's why I think PE could expand. And again, that really pulls the whole market up. Well, we know Tom Lee, he is mostly optimistic, and that's good to know because, I do own a lot of tech, but again, at some point, valuation is going to be in question. This right here is the entire market. So Microsoft, Apple, Google, Amazon, all of them pushing higher. Google did have some announcements today with their phone, folding phone, AI, automation, all those things. So we're going to talk about that in a more separate video, but the entire market, so communication services, cyclicals, technology, we had semiconductors, software, all of them pushing higher, with energy pulling back, financials pulling back, and more specifically, of course, American Express and PayPal selling off, and along with consumer defenses also down. So again, this was a rally kind of driven again with just a handful of names. You can kind of see them on the chart right now with semiconductors moving up. So ASML, Lam Research, we did have Clack Corporation, AMAT, we had ServiceNow, Nvidia pushing up, AMD pushing up, Microsoft, Apple, Google, Amazon, Mercado Libre, and Meta was slightly down, and Tesla I think was also lower, 36 basis points, so more or less flat on the day so far. So comm services, tech, real estate, utilities, big leaders on the day over the last 1 week. They're the ones that are actually leading the market. And in the last 1 month, again, tech and comm services, the two sectors leading the market up over 2% each, with energy down over 6% at the moment. So going over to the actual futures and commodities, lumber prices up, sugar prices up, cocoa prices pushing higher, platinum also higher, with coffee, live cattle, VIX, and canola selling off. Bitcoin's back over 27,500, Ethereum a little bit over 1,800 at the moment, and right now we're just seeing that consolidate sideways. We did have the actual stocks, mining stocks, push higher because I think there's some conversations around higher fees for mining cryptocurrencies, and as a result, Riot and Mara and CleanSpark, they were all up 7, 8, 9, 10, 12% on the day. And when it comes to crude oil, we're just consolidating sideways at that resistance. That's going to be at $73, $74 a barrel. So right now we're just moving sideways at those levels for crude oil. Now when it comes to volatility, so we are seeing VIX down 4%, back under 17 levels. Again, it stays pretty subdued, pretty silent. We're not seeing a big spike, big move here in the VIX. We did see that over here. During the Fed meeting, we got up to as much as 21, 22 levels, and we crushed right back down as the markets once again recovered back up to that level. Now coming over to the NASDAQ, so you can see that we are now starting to break apart from that resistance for the first time. So NASDAQ closed above 12,300, and this is a potential opportunity for the bulls to fully take over and start breaking to the upside even more. So next target is going to be at 13,000. So this right here is going to be that level to watch as a next resistance. When it comes to the NASDAQ, it is still down a little bit over 24% from its all-time highs. So we are still very much in a bear market, in a technical bear market, so to speak. And it would still require a 31% rally to get up to levels that we saw back in 2021, 2022. So that's going to be 16,000, over 16,000. But right now we are very much starting to see some momentum, some breakout to the upside at 12,300. But of course, a lot of it is on the back of a handful of companies. You can see the NASDAQ 100 was up more than the NASDAQ composite, up over 1.11%, and it's already starting to break to the upside even further. Next target is going to be 13,700 for this particular index. When it comes to the S&P 500, so you can see that we're still nowhere near close to that resistance from back in April or back in February, and the reason for that is, again, S&P 500 is more broad-based, and it's not just a handful of companies, and for those reasons, we're not seeing a broad-based rally. We're seeing a very concentrated move to the upside. So market breadth continues to concentrate on just a handful of companies. And another example for that is RSP. RSP was actually down. It was flat on the day. It's actually crazy how RSP was flat, because this gives you a little bit more insight into what's actually moving. You know what I mean? Like, because this is an equal weight ETF. If this one's flat, that means nothing happened. No stocks went up, no stocks went down. It was flat, right? Even though tech, within this ETF, even though tech went up, other sectors were down and selling off. So net, nothing happened. But because NDX and IXIC, these are NASDAQ composites, these are market cap weighted indexes, that's why they're pushing higher, and we're seeing a lot of momentum for them. So tech really is driving the entire market right now. So when it comes to individual stocks, Twilio, by the way, got bought up intraday, was trading as low as 45.68, and it ended up getting bought up over 7-8% on the day. Rightly so, because we talked about how this is absolutely starting to become no-brainers. And we're now almost trading at their net liquidation value. So I did a video on them earlier today, so make sure they do check that out if you haven't already. But going back over to Apple here, getting a very nice move to the upside of 173.50, so that's going to be that level to watch. Resistance all the way up to 177 for Apple. Talking about Amazon also seeing a very nice move to the upside up to $110, so we're seeing a 3% gain, and next resistance really is going to be $114, $115 per share for Amazon. Talking about Tesla, and Tesla here on the day also just really trading sideways and not really going anywhere. We've talked about the 175 resistance. So you can see the high for the day was 174.63. So we're really just trading sideways inside this red rectangle at the moment. So we're not kind of seeing any momentum for Tesla just yet. Talking about NVIDIA, and NVIDIA here is really kind of coming up to that resistance. It's trying to tap or knocking the door on that resistance at 292. A breakout above this level can put us on target to 347, but that obviously is going to be the big level to watch. And of course, we've got earnings coming out for NVIDIA very, very soon. Advanced Micro Devices had a little bit of an inverted hammer candle, and that's one of the reasons why I did end up selling covered calls on this when it was up over 4% on the day, because it was approaching that resistance again at $102, $103. So I decided to sell a call above 102. And of course take advantage of that momentum back higher. So as soon as the prices started rolling over, covered calls as a hedge started paying off. So that's really going to be the game plan moving forward. As it continues to move up, I will be selling covered calls. If it continues to sell down, I will be looking at selling cash secured puts. Talking a little bit about PayPal, and PayPal here unfortunately continues to sell off. Another pretty strong red candle on the day, down over 3.83%. Not as much as yesterday, but definitely selling off quite aggressively. There is unfortunately no support in sight for PayPal. All we can really do is just wait patiently and see where these sellers exhaust their selling pressure and where PayPal actually starts to find some support. And at some point, valuation is going to be questionable, right? It's already trading at, if you do the math, $63 divided by 5. It's already trading at 12.6 times forward earnings. So it's already at a really, really low level. And if you divide that 1 divided by 12.6, we're looking at almost an 8% earnings yield for this company. So that is already a very, very cheap valuation for this company. So it does start to feel a lot like Meta 6 months ago, where there was a lot of negative sentiment, and everybody's talking about how PayPal is dead and Apple is going to take over, and it is done. It's going to zero. It kind of feels that sentiment's coming back again, but this time it's not Meta, it's not Netflix, it's PayPal. And we've seen this story play out over and over again. Hey, this time could be different, and those are some of the most dangerous words in the markets. That this time is different, and it very well could be. But again, the fundamentals speak for themselves. Revenue grew, TPV grew, active accounts did decline quarter over quarter, but still grew year over year. Engagement was up, and of course earnings were up. Free cash flow was up, and the guidance was also up. So there's a lot of things in the report fundamentally that were suggesting and pointing in the right direction. But of course, the emotional value is the sentiment that's driving the price lower. So that's where we are. Square here continues to sell off as well. So I feel like both Square and PayPal are down year to date. I could be wrong, but Square's down 13%, and PayPal obviously is down over 20% here. Actually, only 14%. Wow. So before the sell-off from yesterday, PayPal was actually up on the year. Anyway, so it's only down 14% on a year-to-date basis. But when it comes to from all-time highs, PayPal is down over 79%, and Square from its all-time highs is down a little bit over 80%. So they're both trading similarly. So I can make a case that, if you're just going off of the stock price and if you're just going off of the price action, Square, PayPal, both down 13% year to date. Square, PayPal, both down 80% from all-time highs. Are both of these companies dead? Are both of these stocks going to zero? Right? If you're simply following the logic of looking at the price action in the stock itself. If you follow that logic, you got to follow it all the way through, right? We got to look at all companies that are down 13% and their stock prices are down 80%. Are all of them dead, right? And not so, right? In my opinion, because the company fundamentals are what really matters. And sometimes we do see that disconnect where the market can go crazy and the stock prices are trading significantly lower than their actual true value, their fair value. And we've seen that happen. There are case studies, real life, with Meta, with Netflix, with Tesla, with Apple, with Microsoft. There's so many companies out there that have kind of gone through this ebb and flow in the market almost all the time. Now going over to Meta, and Meta here on the day starting to pull right back down. So very, very flat resistance at 236, 237. So getting rejected here exactly at this level. No surprises there. And then finally, we got Netflix. We've got Netflix starting to break a little bit to the upside, up almost 1%. Next resistance and target is going to be at 348. So this right here is going to be that level to watch for Netflix moving forward. And again, support level is going to stay up at 275, 276. Finally, we come down to Google, and Google here is starting to see a pretty strong breakout for the first time, up over 4%. We're seeing a very nice move to the upside. Next resistance is going to be at $123. So this right here is going to be that level to watch for Google. And finally, we got Microsoft, and Microsoft is once again tapping onto that resistance, kind of knocking that door at around $312, $313. So this right here is going to be that level to watch for Microsoft moving forward. And then finally, we got Shopify sitting at just under 1% in losses and starting to pull right back down. RSI MACD very, very overbought, so I wouldn't be surprised if it starts to pull back a little bit down to $54, and that's going to be that support level to watch. So that's going to be all for today. Hope you guys enjoyed this video and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining us. And of course, getting access to all the buy and sell alerts, options alerts, trade ideas. Everything's going to be included, as well as the new text channel if you are interested in that as well. As always, happy investing. I'll see you all in the next video.